Everyone, and welcome to the Joint Economic Committee hearing the Fed at 100 and monetary policy close the growth gap and promote a sound dollar. This year marks the centennial of the Federal Reserve, so it's appropriate for the Joint Economic Committee to examine the Fed's role in the current economic climate as well as its focus for the next 100 years. Today's hearing on monetary policy is the third in a series that touches on our most vexing economic challenge, the growth gap. We're all rooting for America to bounce back, but regrettably, the U.S. economy is missing 4.2 million private sector jobs and $1.3 trillion in real output due to the gap that exists between this weak recovery and the average recovery of the last 70 years. For every American, the growth gap means that he or she has $2,935 less in real disposable income at this point in the recovery. This gap persists despite extraordinary actions by the Federal Reserve to stimulate growth and employment as part of its dual mandate. Even more troubling, the Congressional Budget Office projects that the future growth rate for America's potential real GDP will be a full percentage point below its post-war average, which may not sound like much, but the consequences are alarming. With 1% lower growth, our economy will be $31 trillion smaller in 2052, and the Treasury will collect $97 trillion less in tax receipts over the next 4 decades, making it significantly harder to balance the budget and reduce America's risky level of debt. The question before this committee is whether the extraordinary actions taken by the Federal Reserve are capable of closing this growth gap, and if a focus instead on price stability and establishing a sound dollar will provide a stronger foundation for economic growth over the long term. Since 2008, beyond the appropriate role of lender of last resort to financial institutions and markets, Federal Reserve has selectively bailed out investment banks, maintained interest rates at an extraordinarily low level for almost 5 years, engaged in 3 rounds of quantitative easing by buying massive amounts of treasuries and mortgage-backed securities, and indicated that the Fed will continue this accommodative monetary posture till the unemployment rate falls to 6.5%. But can the Federal Reserve boost real economic growth over time through discretionary monetary policy? Or should the Federal Reserve adopt a rules-based monetary policy to achieve price stability and let Congress and the President determine the combination of budget, tax, regulatory, and trade policies that will boost real economic growth to close the growth gap? In 1977, Congress established a dual mandate for monetary policy that gave equal weight to achieving long-term price stability and the maximum sustainable level of output and employment. During the 70s, as you may remember, the Federal Reserve's monetary policy was discretionary and interventionist. The results were accelerating inflation, short expansions, frequent recessions, and rising unemployment. In the early 1980s, Chairman Paul Volcker broke the back of inflation. Over the next 2 decades, monetary policy became increasingly rules-based. The results were outstanding. Low inflation and 2 long and strong expansions, interrupted only by a brief, shallow recession. Since the Great Moderation, as it's called, monetary policy has again become discretionary and interventionist. Not surprisingly, the results are disappointing. From 2002 to 2006, Chairman Alan Greenspan kept interest rates too low for too long, which helped to inflate an unsustainable housing bubble. Chairman Volcker and Greenspan correctly believed monetary policy could contribute to achieving full employment if and only if the Federal Reserve focused solely on price stability. Beginning in 2008, however, the Federal Reserve explicitly deviated from this view, invoking the employment half of its dual mandate to justify its extraordinary actions. In January 2012, the Federal Open Market Committee correctly observed in its longer-run goals and policy strategy this statement: the maximum level of employment is largely determined by non-monetary factors that affect the structure and dynamics of the labor market. Despite the clear admission of the limits of monetary policy to spur employment, in December of the same year, the FOMC announced that it would, 1, expand its current round of quantitative easing, and 2, retain its extremely low target range for federal funds for at least as long as the unemployment rate remains above 6.5%. To achieve a policy objective, Nobel laureate economist Robert Mundell stated policymakers have to use the right lever. Monetary policy affects prices over the medium and long term. In contrast, its budget, tax, and regulatory policies are what affect real output, real investment, and employment. Monetary policy cannot solve the problems that poor fiscal policy has helped create. By targeting the unemployment rate, the Federal Reserve is attempting to use monetary policy to achieve what the Fed acknowledged 11 months earlier that it cannot achieve, full employment, while risking what economists acknowledge that the Fed can achieve through appropriate monetary policy, long-term price stability. To close the growth gap, my belief is that we must refocus the Federal Reserve on a rules-based monetary policy, which is a necessary but not sufficient condition for robust real economic growth and job creation. This is not a false choice between jobs or stable prices. It's a proven acknowledgement that stable prices and a sound dollar create the best foundation for job growth over the long term. Congress, which has delegated its constitutional authority to coin money and maintain its value to the Federal Reserve, should provide it with the clear direction to return to an achievable mandate for price stability. The Federal Reserve should also ensure a soft landing for the housing market by initiating a slow and orderly unwinding of its $1.1 trillion position in federal agency residential mortgage-backed securities, gradually reducing the excess reserves that could be the fuel for future inflation, will reduce market uncertainty, strengthen the foundation for non-inflationary economic growth, and reduce the likelihood of undue political interference in Federal Reserve policy. So looking to the future, today's hearing provides this committee with the opportunity to hear from two of the most distinguished monetary economists in the world on their recommendations for the role of the Federal Reserve during its second 100 years. Dr. John Taylor is the creator of the Taylor Rule, which central banks have used to implement a rules-based monetary policy. Dr. Adam Posen served on the Monetary Policy Committee of the Bank of England and is a widely acknowledged expert on Japan. We are fortunate to have them with us today. We look forward to their testimony, and with that, I would like to recognize the Vice Chairman of the Joint Economic Committee, Senator Klobuchar.
Thank you very much, Chairman Brady. Thank you for holding today's hearing on our nation's monetary policy and the mission of the Federal Reserve. We're fortunate, as you've noted, to be joined by two witnesses with deep knowledge on these issues, and I want to thank both of you for being here today. Since the financial crisis began in 2007, the Fed has used many tools to bolster the economy. It has kept short-term interest rates near zero since late 2008 and taken action to keep longer-term interest rates and mortgage interest rates low. However, as I have said before, I always believe that we can do better, and we've been working in the Senate on a number of issues with accountability and greater transparency, and I appreciate the fact that Chairman Bernanke will be coming before this committee in May. While the economy is not yet out of the woods and too many Americans still struggle to find work or make ends meet, we all know that there have been promising signs and that we are a lot better off than we were at the beginning of this downturn. More than 1.2 million private sector jobs have been added in the past 6 months. Unemployment reached a 4-year low last month, 7.6%. I would note in my own state it's 2 points better than that at 5.6%. Housing, so critical to the construction sector, has begun to rebound, with new home sales exceeding 400,000 for 2 consecutive months for only the second time since the crisis hit in September 2008. But even with all the progress, we all know families that are working several jobs that don't have their employment situation back to what it once was, that there are some long-term unemployment issues, and that there are other problems that need to be solved. The Fed, which is buying about $85 billion in Treasury bills and mortgage-backed securities each month to further reduce long-term interest rates, continues to play an important role in the recovery. A survey released today by a Minnesota business group shows Minnesota manufacturers remain very concerned about the economy. The impact of the Federal Reserve past and current efforts would have been diluted if the Fed were restricted to only purchasing short-term U.S. government securities, as some have proposed. In 1977, 64 years after the Federal Reserve System was created, Congress clarified that the Fed's mission was to promote maximum employment and stable prices. The question raised in today's hearing is whether now is a time to change the Fed's goals to focus only on price stability. I think now is not the time for the Fed to take its eye off promoting employment. I note that presently inflation is in check, about 1.3% over the past 12 months, according to the Fed's core measure, and there is no sign of inflation for the foreseeable future. Additionally, the Federal Reserve has signaled that it has an exit plan to change course once the economy is stronger than it is today. While there have been improvements in the employment situation, it's clear that the economy is still healing from the downturn. Yet requiring the Fed to focus solely on price stability would be directing it to essentially ignore employment. I believe the Fed does not need a change of mission at this time in our nation's recovery. I'm looking forward to questioning both of you on this, as well as Chairman Bernanke. I believe, though, that Congress must do more to bring our debt down in a balanced way. I think it's worth looking at the Senate's budget proposal. We did pass a budget a few weeks ago, as well as the one that has been proposed by the President and the House, and I'm hopeful we can come together in a bipartisan way to bring the debt down without causing what Chairman Bernanke has called a sharp contraction in the economy by setting us back. I believe we can bring the debt down with a mix of revenue and spending cuts, and at the same time invest in those core things that are so important: education, our economy, making sure we move forward with exports, and doing all the things we need to do to train the workers for the jobs that are available today. With that, we have about a minute left, and I would love to turn it over to Mr. Delaney to see if he'd like to add a few words for my opening.
Yes, thank you, Vice Chair Klobuchar. I do think today's discussions, which is important, we should also think about it in the context of what's happening in the real and political world, because I agree with the Chairman that Congress has a much more precise instrument in terms of stimulating growth in our economy through comprehensive immigration reform, adopting a national energy policy, investing in our infrastructure, improving educational outcomes, changing trade policy. And to do many of these things, we have to address our fiscal challenges, obviously. But Congress's inability to use this precise instrument has to be considered when we think about changing the Fed's dual mandate. Because when we analyze the Fed's dual mandate, it's important not to do it in a vacuum, but to do it in the context of the real world and the political world that we live in, because Congress has been unable to do the things we need to do to stimulate economic growth in this country. And I think it's important that we evaluate the dual mandate of the Fed in that context, not in a vacuum. Thank you.
Thank you both. We are honored to have these two witnesses with us today. This is the appropriate time to be asking just some constructive, thoughtful questions about the Fed's role, both in today's economic climate and in its second century. With that, and both Dr. Taylor and Dr. Posen are leading experts and widely respected in this field. So with that, Dr. Taylor, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Vice Chair, for inviting me to be here. I appreciate it. In the invitation letter, it asked me to comment on the departure from a more rules-based policy by the Federal Reserve. I think there has been such a departure. I think it's quite large, especially if you compare it with the type of policy of the 1980s and the 1990s until recently. In my view, this departure has led to problems. It's led to a poorer economy than otherwise, and after all, we've had a great recession and a very, very weak recovery. In my view, the departure began around 2003, 4, and 5, where the Fed held interest rates much too low compared to the conditions in the economy at the time, and also compared to the policy that was followed in most of the 80s and 90s. This is one of the reasons we had the excesses, the search for yield, the risk-taking, the boom in housing, and ultimately the bust, which led to the financial crisis itself. In my view, those kinds of actions, interventions continued right up until the panic itself, and certainly didn't prevent the panic. In my view, they were basically harmful. During the panic period, I think it's very important to point this out, the actions of the Fed in providing liquidity were positive. They bolstered confidence. They got markets moving again. However, when the panic subsided in late 2008, early 2009, rather than let those facilities draw down, the Fed continued its interventions. We began to see the quantitative easing, the massive purchases of Treasury securities, the massive purchases of mortgage-backed securities, the Operation Twist, and the continued extension of the zero interest rate policy, not only to the present, but into the future. It seems to me that if you look at this, and I have for this whole period, it should make you worry. Back in 2009, I warned that these kinds of policies would cause risks and would be harmful to the economy. And to be sure, the results have been disappointing. Forecasts much lower than what the Fed said would happen in this period. It is hard to make the case that these policies are working. It's for this reason I think it would be appropriate for the Fed to begin to consider exiting from these policies. Of course, it should be done in a gradual, credible way so as not to upset markets. Indeed, I believe that if it is done in such a way, it will remove risks to the economy that are currently holding back the expansion. I think there's an opportunity to make this exit if, in fact, we have a bit of a growth spurt this year. What it could lead to is an extension of a growth spurt, and we've seen several of them in this disappointing recovery, but make that growth spurt more sustained so we get the real recovery that we've been hoping for, which will bring unemployment down. In the invitation letter, I was also asked to comment on what kind of rules-based policy the Federal Reserve should follow. It seems to me we have tremendous experience and things to learn from history in this regard. In particular, in the 80s and 90s until recently, the Federal Reserve adhered more closely than really at any other time in its 100-year history toward a more rules-based policy. It wasn't perfect, but it was very close. The results were dramatic. Unemployment came down. Inflation came down. Economists look back on that period and see how stable it was. They have a name for it, the Great Moderation, because it was so stable. It worked. So in many respects, we need to get back to some kind of a rules-based policy for the instruments like that. The world is different. It doesn't have to be exactly the same, but a rules for the instruments. It is very important to have a target for inflation. But that's not enough if it's accompanied by a do-whatever-it-takes philosophy, because that will lead to these interventions, which quite frankly have been disappointing, as we all know. One way to integrate a rules-based philosophy into monetary policy would go back to the requirements that the Fed report its strategy for its instruments. Those requirements were removed from the Federal Reserve Act in the year 2000. Those should be put back in. The Fed would be required to report its strategy for its instruments of policy, whatever it chooses to do so, and describe how they will follow them. And if they deviate for an emergency or for whatever reason, come back and explain this to the Congress. I don't think the Congress should tell the Federal Reserve what kind of strategy to follow for its instruments. But it should ask the Fed to report explicitly on what that strategy is, and if the Fed deviates from that strategy, to say why as soon as possible. It seems to me that way the Congress would be exercising its constitutional authority without interfering with the day-to-day operations of the Federal Reserve. Thank you for the opportunity to testify.
Thank you, Dr. Taylor. Dr. Posen, thanks for joining us here today. You're recognized.
Thank you, Mr. Chairman. Thank you, Vice Chair Klobuchar. Thank you all. I'll try to be very brief and as timely as my colleague John Taylor in hitting the mark. I think it is entirely right and appropriate for committees of this Congress to be examining the performance, and not only the performance, the goals of the Federal Reserve. And I think it is perfectly reasonable after 5 years from the crisis to be doing that. I broadly support the idea of Chairman Brady that a commission about the Fed is, if done correctly, can be a productive thing. But let me give you 3 comments on how I think it needs to be done in order to be productive and about what kind of goals need to be set. Independent central banks are useful. They keep inflation down. They keep politicians out of monetary policy. As Stanley Fischer pointed out 20 years ago, there's a distinction to be made between the instrument independence, the ability of a central bank to set its policy instruments at any given meeting or series of meetings, versus goal independence, the ability of a central bank to say what it cares about. And I have always believed, along with he and a large number of other economists, that it's right for elected officials to set the goals, and it's wrong for elected officials to interfere with the instruments. I think it is entirely viable to make that distinction, even though there are obviously specific cases where those things can get muddied, but that's no more of a challenge than when Congress oversees any other agency or the military or any other independent group. Therefore, I think it is reasonable to speak about Congress looking in a multi-year framework what should be the targets of the Fed, what should be the goals, as long as you don't do it too often. Whether it's 100 years or 5 years, this Congress has not done it too often, so I welcome that. I do think it's important, though, to realize that the goals have to be practical. So just to give 3 recent examples, in Japan, they just turned over the new central bank head, and they reaffirmed a stronger commitment to raising out of deflation. That was done in full respect of the central bank's independence. They waited until the governor's term was up before replacing him. They did not change the rules of how the Bank of Japan met. They simply asserted, you haven't done a good job of meeting it, and here's how we're going to hold you to account. In the UK, where I served, they recently announced a review of the inflation targeting regime that had been in place for 15 years. They did it with a finite length of time, a fixed, transparent set of reports, and then they immediately said, well, we want to fix this and this, but we actually are pretty happy with the regime. I'm not going to say whether that was right or wrong, but the point was you have to have a commission or an examination that's open to making no changes if you come to the conclusion. You don't want to simply have threats of changes be a way to bully the central bank into doing what politicians want. Third, we have the contrast with Hungary, which right now, for a number of fronts, not just monetary, is going in an anti-democratic direction. And they have, rather than examining the goals of their central bank, overthrown their central bank essentially, packed it with political people, fired a number of staff. Obviously, no one on this committee or this Congress would do that, but that's an example of how you can interfere too much. So what in practice are the kinds of goals you might want to set? I say practical because if you just do broad goals like price stability or full employment, it just gets into politicization, too much vagueness, too much room for interpretation and discretion on the part of the central bank, and then too much debates about what accounts, what is accountability. That's why I and Chairman Bernanke and others worked together advocating things like inflation targeting for the U.S. some years ago. The point of inflation targeting is not a sole focus on inflation. We're very explicit about that, nor am I saying inflation targeting is necessarily the right way. What we did say that I think is important is you need to have a transparent set of goals, a set of goals that is measurable, a set of goals that's subject to review, a clear hierarchy, but allowing for there to be more than one goal, depending on what the conditions are, a time framework of, say, 2 to 3 years on which progress is evaluated. These kinds of practical transparency steps, I think, are applicable to whatever goal the Congress sets the Fed. Finally, on the question that has been raised about real activity or not, I'll have to respond to this more, I hope, if you give me the opportunity in questions, but I see no conflict here. If the Fed was trying to put employment up above full employment as we did in the 70s, as the things to which Mr. Chairman Brady and Dr. Taylor referred, that would be one thing. But we are well below full employment. There is no sign of any inflation. And all these credit bubbles that we're concerned about do not correlate with monetary policy. There's no strong evidence of that. All there is evidence that if you let bankers get out of hand, then you will end up getting a lot of corruption. That's bad. That's something we need regulation to deal with, but that's not a monetary policy issue. The final question, which was raised, 5 seconds, should we be limiting the Fed to just buying short-term instruments? The answer is no. That's what the Bank of Japan did for 10 years, is they only bought things of less than 3-year duration government bonds. They were essentially printing cash to buy cash, and as you would expect, that has no impact on other investors' behavior. If you want to have traction on the economy, you have to buy something other than cash.
Thank you, Dr. Posen. Let me start with you, Dr. Taylor. As we discuss the mandate of the Fed, and as those of us who believe we ought to refocus it back to rules-based price stability, which protects the value of the dollar over time, good money as it is. Should we have that mandate, does the Fed ignore employment factors in pursuing stable prices over time?
No, absolutely not. The experience, it seems to me, with this is when the Fed took specific actions to try to deal with unemployment. The 70s is an example. It backfired. Unintended consequences were high inflation and ultimately higher unemployment. Unemployment got to be 10.8% by the end of that episode. I think the recent experience is similar. One of the reasons the Fed held rates low in 03, 04, 05 was a concern about employment. What has happened? We've had much higher unemployment than anyone would want. So the history is pretty clear that these unintended consequences of these actions lead, and it's because of policies that are chosen that are counterproductive. I think the problem with the dual mandate now is it's really used as an excuse to do more interventions, more discretion than would otherwise be the case. So my hope that a focus of the Fed to price stability, which would generate more over all economic stability would be quite positive for unemployment. We get a lower unemployment rate than people are legitimately concerned about if you remove that mandate. It's really monetary policy works with lags. It's dynamic. It takes time. And what we've seen in history is these efforts go the wrong way, and it's a concern to me.
Do you believe the Fed's current accommodative monetary policy will help close the growth gap, or do you view a more rules-based policy as helping remove the risks that at this point are a roadblock in economic growth?
No, I don't think they will help. In fact, the history of the last 4 years is that they have not. We've had really the weakest recovery in history for a downturn like we have had. And it's good to say positive things, to be sure, but this is a very disappointing expansion, very disappointing recovery. And there's a lot of reasons people point to, but I think one of them is the uncertainty, the great deal of interventions that the Fed has had here. And so to me, and then history tells you, economics tells you, to get back to a more predictable policy, a policy where there's not so much interference with the economy, would actually help the recovery, and I'm hoping they do that.
Thank you, sir. Dr. Posen, I read your testimony last night. You touched on a lot of key points. I want to pursue your first point you made, which is there's a right way and a wrong way for a legislative body to set goals and hold their central bank accountable. The approach we're taking is to try to create a constructive, brutally bipartisan, in fact, focused a bipartisan approach over the next year to look both backwards on what is the role of the Fed in the economy in the first 100 years, financial security, and all that, and also to create sort of a level playing field for ideas on what that role should be. In your view, is that generally the right approach versus, as you've identified, there's some damaging approaches as well?
Mr. Chairman, no, I am very delighted to be here, and as I said in my testimony, part of the reason I'm delighted to be here is because you and your colleagues and the staff of this committee are framing this in a serious, objective, and I don't know partisan, bipartisan, but open to debate way, and that you would be open, I would hope, to evidence. As my colleague John talks about history, I interpret the history a little differently than he does. I would hope we could have frank discussion about that. And I think the key word that I used in my testimony, and again, I know for this committee, I don't need to tell you that, is you don't want this to be about bullying. You don't want this to be about, we don't like the Fed, what the Fed is doing right now, or we're worried that the Fed isn't doing enough of X right now, and therefore we threaten a change in the Reserve Act, Federal Reserve Act, to get right now what we want. When you frame it, Mr. Chairman, when you and your colleagues frame it as a long-term consideration about what for the next 5, 10, 20 years, I hate to go beyond that, but 5, 10, 20 years should be the Fed's goal. I think that is an entirely legitimate and constructive focus.
Great. Thank you, Dr. Posen. Vice Chairman Klobuchar?
Thank you, both of you. I appreciate your testimony and your comments, Dr. Posen. We truly are trying to approach these things on a bipartisan basis here, a civil way, as we look at the work that we're going to have to do together. I can't agree with Chairman Brady more, that monetary policy alone can't return this economy, can return this economy to good health. I think it has to be a combination of the work that we're doing in Congress, and as Mr. Delaney articulately pointed out, there is a lot of work that needs to be done in Congress that hasn't been done. But I want to get back to the point both of you made about this idea of setting goals from Congress, but at the same time, I know, Dr. Taylor, you said that the Congress shouldn't be getting involved in dictating what instruments are bought and those kinds of things. Could you expand on that, about what would happen if we got too involved in the details of this?
Yeah, there's lots of decisions that are made on a day-to-day basis, technical decisions. Seems to me the best thing is for the Congress to delegate those decisions about the instruments of policy to the Federal Reserve, to our central bank. You'd be exercising your constitutional responsibilities that way. I do think, though, that you have to go more than just say, hit an inflation goal, because especially in the last few years, we've seen how a whole wide range of instruments will be used to try to achieve that. It's not predictable. They've changed the strategy several times in the last 4 years. They're groping for something that will work. And so that's not a strategy. It's tactical. It's not something that people can understand. You're guessing. We're guessing all the time what the Fed is going to do next. That's not good. That's not predictable. But the Fed can report to you, report to the Congress more generally, to the appropriate committees, what its strategy is for the interest rate or for reserves, whatever it happens to be, explicitly as it thinks appropriate. And you can judge that. Is that a good? Other people can judge it and make an assessment. We can have a good debate about what it is, but we don't have that now. The goal itself for, say, price stability, whatever you want it to be, is not sufficient. Policy works with a long lag. It's not an accountable way to approach things. So that's why I think the strategy is so important.
Okay. And Dr. Posen, do you think it's the right time to change the mandate of the Federal Reserve by statute?
Madam Vice Chair, no. Full stop. I think it's both a wrong time to do it because the Fed's policies right now are constructive and making a positive difference without in any way imperiling a sound dollar. And I think it would be a mistake based on the knowledge we have now about how central banks work and how economies work to change the dual mandate even when we're in recovery. I think it is the responsible and right thing to do. Dr. Taylor spoke about instrument changes and tactical requirements. I think too much is being made of that. There seems to be this horror of a central bank that actually tries to do its job and adapts to circumstances. I think that's a mistake, any more than you would tell the military, God almighty, you're using tanks and drones rather than foot soldiers. That must mean you're doing something wrong. No, that's not how you act. You ask the military, are you doing an acceptable job? Are you incurring too many casualties, causing too many side effects? Those are all reasonable questions. But then getting into, is this the right way to fight the fire? Is this the right way to land on the beach? That's not something Congress should be doing. If I could make one more point, when you talk about history, as I said in my written testimony, these kinds of so-called unconventional policies were what central banks did for the preceding 200 years. They bought and sold private assets. Now, there were disadvantages to that, but they were small. And this rules-based period that Professor Taylor and others invoke as a golden era of the gold standard, for example, was a period when central banks were buying and selling private sector assets with large balance sheets. And so there was no contradiction between adherence to the gold standard and price stability and having involvement in private markets. So I think we should stop fear-mongering about that and focus on the goals rather than the instruments.
And what do you think the best thing Congress should do right now? Just take it out of the Federal Reserve right now in terms of what we should be doing with the tools that we have, which, as Congressman Delaney pointed out, are much more targeted and we can do things more quickly.
I fully stipulate to what Congressman Delaney said. I mean, and this is still in the spirit bipartisan of everything everyone has said so far, which is the Fed can't really affect the maximum rate of sustainable employment. It's these longer-term structural factors that matter. The Fed can affect how close we come to that at any given moment. And so for the Congress to focus on things that would bring up the rate of sustainable employment would be positive.
Okay. Thank you very much.
Thank you. Representative Hanna.
The Fed has said, the FOMC, set a target employment or unemployment rate. And they've said in their own words, the maximum level of employment is largely determined by non-monetary factors that affect the structure and dynamic of the labor force. Knowing that, we, in terms of America being competitive, in terms of, as Mr. Delaney said, education, immigration, a very complicated tax code, exports, and a lack of a national energy policy, how realistic is it for them to have that in writing, and believe that, I think, and set a policy of unemployment? Knowing that all jobs are not the same and that we have structural problems that are both long-term and short-term in our economy, do they set themselves up for defeat by saying that?
No. They simply set themselves up for being humble. Sorry, Mr. Congressman Hanna. In my view, they simply set themselves up for being much humbler about what the Fed can achieve and how they should act than they did in the previous 2 decades. I was very struck in Professor Taylor's remarks about how wonderful these various periods were when the Fed stuck to rules-based monetary policy and how bad things are now, as though the monetary regime was the only thing that determined these wonderful outcomes or these terrible outcomes, or at least was a dominant thing. And as you just read, and as Mr. Delaney said, that's exactly wrong. The Fed basically has some control over credit conditions and over how hot the economy runs versus this limit. And so I think it is entirely appropriate, but in no sense inconsistent, to say to the Fed, don't presume you know exactly what the top level of unemployment is. Be subject to checking that, as you failed to do in the 70s. Mm-hmm. But your job is, given whatever Congress decides, given what the elected representatives of the world leave you with, to try to get the most stable growth and the most stable inflation you can, given those conditions. And I see no contradiction as long as Congress and the media do not expect too much to the Fed saying, we're creating jobs, we're getting us back to full employment. These may or may not be great jobs. That is for elected officials to decide, not for the Fed.
But are they setting themselves up with a wrong premise, a wrong-headed premise?
Not at all. I don't think, as you just read, I don't think there's anybody at the Fed, from the chairman on down, who thinks that by trying to get the economy to grow, to recover, is doing anything about the long-term structural issues, except possibly the following, which is, we know, and I think you and I discussed this before the meeting, that when people are out of work for a long time, it sometimes becomes very difficult for them to get back into work. It sometimes becomes very difficult for them to get rehired, whether they're an older worker who gets labeled or a younger worker who fails to get on the ladder. And so there's an excuse or a reason for the Fed, I think it's not an excuse, I think it's a genuine justification, excuse my language, for the Fed to try to keep the economy running as close to full employment as possible under serious conditions, because you don't want that to kick in.
Dr. Taylor?
I think the Fed now says the long-term normal unemployment rate is 5.6%. I think that's what they've said. And they're trying to, their goal is to keep the fluctuations or the deviations of unemployment from that number as small as possible. But of course, they haven't accomplished that by any means. The performance is much worse in the period I'm referring to, say, than it was in the 1980s and 1990s, a much more stable economy than measured by their own criteria, the same exact criterion they're using right now. And I think monetary policy does have an impact. It's one of the most powerful macroeconomic instruments there are. And it can be a force of good, and it can be a force of harm. There's no question about that. Throughout the history of the Federal Reserve, I think you can point to more periods where it's been harmful. Take the Great Depression. It was terrible monetary policy. I think the same is true of the period now. So, and we have good periods, and we should look at that history. And there's other things that go on in the economy. Your responsibility of the budget is very important. Regulation is very important. But don't discount monetary policy as not a major factor in these economic developments.
Thank you.
Thank you. Representative Delaney.
Thank you, Mr. Chairman. 2 quick questions for Dr. Taylor, and then I have one for both Dr. Posen and Dr. Taylor. Dr. Taylor, you said something interesting in your testimony, that you think it would be a great opportunity for the Fed to unwind or to begin to unwind its position during periods of growth that we may or may not see during the next year. To the extent Congress were to put in place a grand bargain deal of significance, how much of an opportunity do you think that would create for the Fed to begin to unwind its position?
Well, if such a grand bargain, responsible approach to fiscal policy is positive for the economy, that would begin to create this good news, and I think it would be an opportunity for the Fed. But it doesn't have to be the Congress action. It can be other action itself.
In case we needed another reason to work on something, I thought I would try to get that out for the record. And my second question for you is, you talked about how oftentimes there's a correlation between the Fed using monetary policy to stimulate employment and the fact that there has not been a measurable, immediate change in the trajectory of employment. Is that really a fair standard? Because it seems to me the Fed often uses monetary policy to stimulate employment just at the time we start seeing accelerating unemployment, and that the Fed really should be judged based on how much it mitigates further unemployment as opposed to holding it to a standard of achieving its unemployment goals. Because again, I tend to think about the world or these decisions in the context of the real practical world as opposed to kind of abstract or standards in a vacuum. And I'm not sure it's fair to judge the Fed based on the fact that they haven't achieved, or we haven't achieved, what we all view as optimal employment, and to say that their policies have not worked. Isn't there some truth to that statement, that we really have to look at the mitigation effect as opposed to just whether they're hitting their absolute standards?
It's a very good question, but I think my characterization of the events is more that the Fed took action, say in the 70s, and later on you have these adverse consequences. The Fed took actions in 2003, 4, and 5, and later on you had this crisis.
Right.
And so it's not the kind of...
But the crisis in 07, 08, it was hard to, I mean, I think you could actually make an argument to the Fed's action after 9/11 did contribute to some of the asset bubbles that were created in the last 10 years, but it's not clear to me that the 03, 04 actions were correlated to that.
Well, the evidence I look at says it's more 03, 04, 05, and I think the Fed's provision of liquidity in 9/11 was appropriate. They provided $60 billion of liquidity. It removed it right away. I wish that's what happened in 2008.
And my question for each of you is, when I think about the Fed's actions recently, I view their actions around the crisis as heroic. I view their actions post-crisis as appropriate. I do have questions about their recent actions, QE3, if you will. And my concerns are that it's a blunt instrument. It's not achieving the results as effectively as actions of Congress would. And I don't blame the Fed for that, because they do have the dual mandate. In the absence of Congress doing something, they are compelled to do it. I also feel like it hurts savers, and it largely helps people with assets, and to that degree continues to drive income inequality in this country. But perhaps my biggest concern is that as the Fed's balance sheet grows and it continues to be long assets, when that time does occur where rates need to be raised, which there's no evidence that has to happen anytime soon based on the inflation data, do you think that the Fed will be affected in their decision-making process by the impacts that raising rates would have on its own balance sheets? In other words, Fed monetary policy, while it's not an appropriation, does have a cost. And the cost is how we unwind this. And the Fed is not a traditional financial institution. It's not at risk based on what happens to asset prices. But it will create a lot of negative headlines, and there will be a lot of discussion about the Fed losing money. It may affect their ability to make payments to the Treasury. So do you think, and this is a question for both Dr. Posen and Dr. Taylor, maybe Dr. Posen first, do you think this will have an effect on their ability to act on appropriate rate-setting measures?
Thank you, Congressman Delaney. I guess you raise an enormous number of issues, so let me just try to quickly respond. I think the distinction of QE3 versus the crisis is one that is now becoming popular, and I'm not sure it's entirely justified. The Fed is continuing to do things that are perfectly reasonable and in line with central bank practice. More importantly, I think you're all going to see over the course of the next year, and in fact are already seeing in some of the statistics Vice Chair Klobuchar mentioned, the recovery in the housing market that is being directly fueled by the restoration of the MBS market through Fed action. And that's going to be an important driver of growth in the year ahead, and it's not going to be a bubble because we've been so low below replacement rate on housing. It's entirely appropriate for the Fed to do that, and it's another example of them buying a non-treasury asset having the right impact. Second, I think you worry about hurting savers. There's so little private sector savings in this economy except by rich people that unfortunately anything we do that stabilizes the economy will always disproportionately benefit rich people, which wouldn't be bad if it didn't hurt other people. However, mass unemployment, mass underemployment, budget deficits that force cuts in progressive programs and Head Start and education and health really hurt poor people. And therefore, what the Fed does to keep growth up is actually far more important than the effect on savers, including people like my mother who live off of T-bill interest. It's still on net better for the poor in this country for the Fed to act. In terms of the balance sheet issue, this actually raises something I should have said to Vice Chair Klobuchar when she was asking what Congress can do vis-a-vis the Fed in general. I find it...
I'm sorry, Dr.
Yeah,
Posen,
sorry.
because you're running, and perhaps we can return to this point with Representative Maloney as well. Representative Paulson?
Thank you, Mr. Chairman. Actually, I think some of my questions will be able to allow some of that same line of thought to occur. I was going to ask just regarding the issue of the impact of the Fed's policies on savers, on seniors, for instance, and maybe that some folks in who are of higher age category they're not making wise asset allocations, for instance, and they may be pushed more towards riskier investments because of declining interest rates. And I know that Chairman Bernanke, back in February of 2013, just recently, he just testified actually that he said the notion that savers are harmed by the Fed's current policies aren't really a factor, because he's argued that as much as there's harm to interest-bearing accounts, savers are also benefiting from other assets like stocks and real estate. He noted that the stock market has doubled in the last few years, and he's expressed conviction that the economy must move forward and pick up steam before interest rates are brought back up. So it kind of follows, just to follow up, what is the proper balance for U.S. monetary policy in terms of achieving that price stability and lower employment in a way that does no harm to American savers or to seniors who choose to forego present income for future security? And maybe Dr. Taylor, you can kind of start off, and we can, Dr. Posen.
Well, I'd say one way to look at this is to just go back to the 80s, 90s until recently. You basically had a policy which would ease in a recession, and it would tighten when inflation picked up. It worked very well. It seems that's the kind of policy you're looking for now. But a policy that says promises zero short-term rate for years into the future, that's an interference with the markets that's very unusual, extraordinarily unprecedented. Don't think this is not unusual. And the massive purchases of mortgage-backed securities, massive, this is not just a few, is very unusual. And those create this uncertainty about how it's all going to be unwound. And the zero rates themselves, they do cause a search for yield. We've seen that in the past. There's also an effort to drive down the long-term interest rates so they don't reflect the information that's coming into the economy, whether it's a pickup or a slowdown. So it's a massive change in policy, and the effect on savers and what they do is just one example of this. So it seems to me we know how to deal with this. We've done it in the past, and I think we should try to do that in the future.
And you suggested that a return to a more rules-based monetary policy would result in normal market-determined interest rates that would reduce those incentives for pension funds and retirees to take on more dangerous risks. So are the Fed's policies right now contributing to a stock market bubble, to a potential housing bubble down the road? Bubbles burst. I mean, is it a contributing factor?
Yeah, one of the problems in economics, we don't know exactly when it's a bubble and when it's fundamentals. I think there's some good things going on with respect to profits. There has been a recovery. It's just terribly weak. Many of the firms you're looking at, their stock prices are benefiting from foreign sales, and the world, especially emerging markets, are doing quite well. And so there's lots of other reasons, more fundamental reasons, but I think you should be worried about bubbles, especially in the in the fixed income market, and to the extent that the Fed is influencing that, I believe they are, that has to be removed at some time. It can only be temporary. The Fed can't do this forever. We can't rely on the Federal Reserve for the stock market in the United States forever.
Yeah, Dr. Posen?
Mr. Paulson, I guess I'm uncomfortable with your initial statement about the Fed should worry about inflation, employment, and no harm coming to savers. The Fed's goal should never be no harm comes to any one group. Full stop. That doesn't mean we shouldn't be honest and look at those issues and admit that there are effects and pluses and minuses, as I think Chairman Bernanke tried to account for. But the idea that the Fed should direct its policies towards any one person or any one type of person, I think, is a mistake. To the degree that there are people in savings who have issues, it is a smaller number than sometimes people think for the reasons that have been discussed. But it is also a question of why haven't other assets gone up in value? Why aren't there other interest rates in the private markets moving? The Fed is not directly influencing those assets. And that gets us back to what we were talking about earlier, which is there are limits to what the Fed can do, but that's not the same thing as saying what they're doing is causing these other problems in the economy. And I think we got to make that distinction.
All right. Thank you, Mr. Chairman. You go back.
Thank you. Representative Maloney?
Great, thank you. Thank you, and I thank the witnesses for their testimony. Since the financial crisis began in 2007, the Federal Reserve has absolutely used every tool in their arsenal to stabilize the financial system and prevent another Great Depression. The Fed, in my opinion, provided a very much needed stability during this time. They opened literally an alphabet soup of lending windows that provided liquidity during this time. Multiple rounds of quantitative easing have kept interest rates low, helped small and large businesses access credit, and spurred economic growth. Without the Fed's expansionary monetary policy, in my opinion, our economy would be much worse than we are today. But unfortunately, the recovery is still very vulnerable. Private sector job growth fell below 100,000 last month. Unemployment is still well above its pre-recession level, and there are more than 3 unemployed workers for every job opening. Dr. Posner, do you believe the Fed should continue to use all the available tools in its arsenal to bolster the economy and help people get back to work? And also in response to Senator Klobuchar's question, what should Congress do to complement the Federal Reserve's expansionary monetary policy? And could you also talk about the risks of shutting down the Fed's bond purchases too early?
Okay. First, thank you, Congresswoman. I agree they should be using every tool. I don't believe yet they have used every tool. There are the commitments to low long-term rates I view as largely cheap talk. I don't view that as a tool. I'm on record suggesting that forward guidance, as they call it, is really unimportant. So I don't think it does much harm or much good. What matters is the actual stance of policy and the actual purchases and commitments, and what happens in terms of actual rate decisions. So I think they should be continuing to look at buying MBS. I think they should be continuing to provide liquidity, and I think they have no risk in doing so. In terms of what Congress should do, let me link the risks back to what Mr. Delaney was saying and Vice Chair Klobuchar was saying. If you're concerned that the Fed may be hesitant about withdrawing policy, and that's a source of uncertainty, or you're concerned that they will self-limit policy because they're worried that people will get agitated about the outstanding balance sheet, the best thing that the Congress can do is guarantee the Fed that they will recapitalize the Fed if there are losses on the Fed's balance sheet. Just the same way that they get all the money back from the Fed when the Fed makes a profit. This is all notional. The Fed is not a for-profit institution. That is not the motivation, nor should it be the criterion for judging Fed policy. You don't want that motivating Fed policy. So therefore, if this Congress were to commit to indemnify the Fed against losses done in its execution of monetary policy, that would be a constructive step and would take this issue off the table, which should not be a consideration in when they decide to exit or not.
And also, could you talk about the risk of shutting down the Fed's bond purchases too early?
Yes, thank you. As I mentioned to Mr. Hanna, there is a problem in this economy that we all recognize, that the labor market has gone really sour in a way that has not been seen in past U.S. recessions, at least not for decades. We've seen participation in the labor force drop by 4 full percentage points. You mentioned in your question, in your statement, the recent poor numbers on the latest month. If the Fed were to stop its bond purchases, since I don't believe forward guidance matters very much, I think it would constitute a insufficient amount of monetary stimulus and probably be perceived as a tightening, or at least a next step to a tightening. I believe unemployment would rise significantly, and we would get the demonstration of the effectiveness of Fed's policies by the reverse. Its withdrawal will cause problems.
I'm interested in your experiences on the Monetary Policy Committee and the Bank of England, and I know you've been a close observer. I understand you had some concerns about their austerity measures and the impact on the economy. And could you comment on the Bank of England? It only has one mandate, as I understand it, managing inflation. And has that single mandate led to better inflation outcomes than the United States, or worse?
As I say in my testimony, it's actually led to very similar policies, and it has led to slightly worse inflation performance. This is arguably in part because the UK is a much smaller economy than the US. It also has a less is much more vulnerable to events in the euro area, which has been a problem for it, and it's had a less sound currency. The pound came down 30% or 25% versus where it was, which the dollar is not. So I think when you look at the UK monetary policy experience, it's not the mandate that matters, it's the nature of the economy. Broadly speaking, we on the Bank of England did many of the same things as the Fed, and broadly speaking, we prevented the counterfactual of much worse outcomes.
Okay, thank you very much. My time has expired.
Thank you. Senator Lee?
Thank you very much, Mr. Chairman, and thanks to both of our witnesses for joining us today. Appreciate your insight, and it's good to have you with us. Dr. Taylor, I was wondering if I could have you discuss how some of the following items might add to the cost of an open-ended quantitative easing process. Unwinding the enormous Fed balance, investments running into risky equities to chase return, creating an assumption that near-term government debt service costs are sustainable, overinvestment in a narrow set of growth assets and the creation of new bubbles, and misallocation of investments. Could you just talk to us about those for a moment?
Yes, Senator, thank you. That list is, I agree with each one of the points as a concern. Unwinding the balance sheet requires selling the mortgage-backed securities and selling the long-term assets. To the extent that has been beneficial, which is debatable, that will be counterproductive. It'll be a restrictive in the economy. It'll also be occurring at the same time. Most likely, the Fed needs to raise the short-term interest rate, and so it's always hard to exit from an easy monetary policy. This one will be hard than ever. So that creates risks. I say, and other on your list, which is important, it gives a potential for a false hope on the budget because it makes the interest rate payment so low at this point. Now, again, to the extent that it is holding rates down, it clearly is holding short rates down. I think the search for yield that you mentioned, that people are going to be taking on risky assets that they probably shouldn't have, that will come back to be a negative, as we've seen in the past. So all these, it seems to me, are serious risks that are being undertaken, and they may involve unfortunate policies going forward. For example, if the Fed is concerned about its balance sheet value, taking capital losses, that may delay its exit. They may hold on to those securities longer than they otherwise should. That's a very real possibility. On the other hand, if they hold on to those securities, it's going to require that they pay banks huge amounts of money for their reserves, because they're now paying interest on reserves, and if they want to have the short-term interest rate be 1%, 2%, 3%, whatever it'll have to be in the future, without reducing the balance sheet, it will have to pay all that money directly to the banks. That's going to be a concern as well. So I've been studying monetary policy a long time. Exits from these are always difficult, and this one is going to be more difficult than ever. And I believe that is already causing concerns about how it's going to unfold, which holds back the economy itself right now.
Thank you. Since the recession's technical end, now several years ago, there has been some troubling correlation between the change in unemployment rate and the size of the labor force. And last week in the New York Times, economist Casey Mulligan noted, as unemployment has gone down, so has the labor force participation rate. In the midst of this trend, the Fed has set a new precedent. It set a new precedent on December 12th of last year by declaring an official unemployment target of 6.5% based on headline unemployment. Given these circumstances, how useful do you think the headline unemployment is as a target?
Well, I think it's more suspect than usual as an indicator of overall demand conditions in the labor markets, because, as you say, people are dropping out of the labor force at a much higher rate than you would expect in the current circumstance. A while ago, the CBO estimated that the unemployment rate would be about 1.25% higher if labor force participation had behaved according to the way it should in these times. So it makes the unemployment rate more difficult to interpret, and is one of the reasons I think people are concerned about the focus on a particular number like that. The Fed has allowed itself wiggle room. It says, well, it's not a for sure thing they will change on that basis, but it's one of the other uncertainties that is making monetary policy difficult to interpret right now.
Has measuring price stability changed in a similar way in recent history?
I don't think so. I think there's always the question about, for example, should they focus on a core inflation rate? I've always been worried about a core measure because ultimately you're concerned about the ultimate inflation rate. In other ways, you could average the inflation rate over a few quarters to get a better indicator. I think the statistical agencies should continue to try to improve their statistics, get better measures of inflation, but I don't think that is a major problem with monetary policy right now.
And then finally, would any of this does any of this suggest that it might be easier from a technical perspective to enforce a single mandate? Oh, yeah, I see my time's expired. Yeah.
Would you like to answer, Dr. Taylor?
I think it would be better because it would remove a lot of the ways and reasons the Fed moves in these discretionary ways. As the chairman indicated, the dual mandate entered the law in 1977. It was at this period of a highly interventionist mentality with respect to policy. But as soon as Paul Volcker came in, it was continued by Alan Greenspan. They basically tried to interpret that law as get inflation down, get price stability, that will generate. And they were very successful in doing that. Now, really for the first time since the 1977 amendments, the Fed refers to it all the time as reasons to do this and reasons to do that. That, I think, is problematic, and that's one of the reasons I would think it'd be better to try to focus on a mandate, not to ignore what's happening in the economy, but to simplify what the Fed is actually doing.
Thank you very much.
Thank you. Senator Coates?
Thank you, Mr. Chairman. Let me divert, if I could, just a little bit from what the chosen topic is today, but in response to the question that Congresswoman Maloney asked, what should Congress do? Two questions, one for both of you and one for Dr. Taylor. Let me start with Dr. Taylor. Dr. Taylor, Dr. Posen's response to that the first response to that was that the Congress should guarantee the Fed that the Fed will be recapitalized if it has losses given its current policies. Would you like to respond to that? I would like to get your take on that answer, that question and that answer.
No, I don't think that's necessary or appropriate for the Congress to do. They have in that respect, the Federal Reserve Act is just fine the way it is. They've delegated some responsibility without backstopping the Fed in that particular way.
My second question is relative to timing, the tools of the Fed versus the tools and the need for Congress to address fiscal policy issues. There's an unmistakable, there's growing consensus, if not full consensus, that the current situation relative to our debt and deficit is such that we are reaching a tipping point. The mandatory spending, it's pretty simple arithmetic, is simply running away with our revenues, causing a lot of borrowing, and squeezing the discretionary side of the budget, which we have control over, and which, as Dr. Posen said, there are things that ought to be addressed that may not be addressed simply because we don't have the resources to do so. Now, relative to timing, many are now saying that we've been talking about this for several years, but there has not been significant structural changes proposed or enacted relative to this runaway mandatory spending, and that if it's not done this year, the political process will potentially push this decision to the point where it can be actually accomplished through a political process to 2017. And therefore, I think even the White House has acknowledged, the executive branch has acknowledged along with Congress that it's got to be done now, or we flip into a 2014 election year, then we flip into a new presidential election process, and it may be 2017. It seems to me two results can happen from that. It's either 4 more years, muddling through 4 more years of tepid growth, less than satisfactory, high unemployment, more squeeze on discretionary spending, or we reach that tipping point during this period of time, which brings another financial crisis. Could each of you just briefly address that question and that issue?
Well, I'll be very brief. I think it's very important to address these budget issues now. It is a good time to do it. I see some momentum. There's an orderly process on the budget is finally coming back. Senate has a budget. I think the proposal to try to get the budget into balance in 2023 makes sense. That's possible to do with a gradual, it's not austerity, it's a gradual, credible plan. But at the same time, as you say, and it's most important, for the long term to get the entitlement spending in line with the growth of GDP. They're both exploding. They're exploding, and that's the problem. So by all means, that's one of the most important policy issues we're all facing.
And the possibility of this tipping point, debt to GDP, occurring in that period of time if we don't take action now?
Well, I think the evidence should make you worry that if you don't address it now, it's going to be harder, and there will be a tipping point. But unfortunately, I can't say what that tipping point will be. We don't know for sure. But why take the risk? It would be better for the economy if we take the action now. So why take the risk of a tipping point?
Thank you. Dr. Posen?
Thank you, Senator. What's striking, I think, about your set of questions and Professor Taylor's response on my issue about backstopping the Fed is that it illustrates how much this conversation is focused on the supposed uncertainty caused by the Fed, whereas everyone's known what the Fed's doing. It's been very clear. They've pre-committed. They've said, and there's been enormous uncertainty generated by the budget process between the Congress and the White House. I know none of you deny that, and you're trying to fix that. I'm just saying I think it is a very misleading statement to talk about the Fed being a cause of uncertainty that harms the economy, whereas the main source of uncertainty, certainly for the last year and a half, has been the obscene budget back and forth between the Congress and the White House. In that spirit,
I don't disagree with
I know you don't. I just want to be clear that when we start,
Understand.
if you start saying uncertainty is part of a real problem here, that to me is the big source of uncertainty, and therefore I support the responsible budget measures that are going forward.
Thank you. Thank you, Mr. Chairman.
I want to thank, on behalf of Vice Chairman Klobuchar and myself and the committee, I want to thank both of you for being here today and your insight. Monetary policy matters. This is the appropriate and I think a critical time to be reviewing their role both today and in the future. We'll be calling on both of you in the future as well as we pursue this issue, how we best close this growth gap, how we return to and create a sound financial dollar, a sound dollar over time, as a foundation for economic growth. So again, thank you very much for being here. Hearing is adjourned.